How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you what is a fixed income annuity and why you may be interested in this, especially towards your retirement planning, your retirement income planning. And essentially, with any sort of fixed income annuity, you understand that you're starting to gear up for retirement. You might be in your 50s, you might be in your 60s. You have a general idea of when that specific retirement date is. Now, rather than just utilizing your existing accounts, such as a cash account, kind of think of it like a bucket or like a 401k account or an IRA account, typically what happens with these sorts of buckets is they're tied to mutual funds. So with the mixture of trying to pull money from these buckets, the potential downward market risk, and then most importantly, and then you also have fees, but most importantly, the risk of outliving your money. This is what scares the hell out of people in retirement. So there's different types of fixed income annuities. You have variations of that. You could utilize that from, an immediate annuity, from just a regular fixed annuity, from an index annuity, from a hybrid annuity, from a variable annuity. I mean, I know I'm basically speaking about all different types of annuities, but understand that each annuity serves its particular purpose, just like any financial product serves their specific purpose. So if your particular goals, if they correlate to a fixed income annuity, it's definitely worth looking into. Definitely worth looking into to see, whether or not you could find the best one that is correct for your situation, and then you try to match that up against the alternative. Do you want to be risky with your money? Do you want to have that worry in retirement where, another 2008 could come along, or, I'm paying all these fees towards my fund managers and my investment advisors, and, it's essentially all the uncertainty involved. So with the fixed income annuity, I like utilizing with a lot of fixed-based accounts. Very safe, very contractually guaranteed accounts on the fixed realm with top-rated insurance companies. So how exactly does this work? And you could kind of do this in the form of two different ways. One is known as annuitization, which I absolutely hate. There's a couple of top advisors out there that have content all over the internet, all over radio, that they absolutely hate utilizing this strategy of annuitization. Or you could use something known as an income rider. And the reason why I like the income rider approach is because you have control of your money, of your actual physical bucket of money, but the longer that you wait to turn on this income, you have a secondary contractual guarantee on the insurance company side that they are giving you lifetime income that you could never outlive. So what do I mean by that? Okay, well, let's say we'll first go with annuitization. Annuitization, this is the bad press that you see with annuities. This is essentially, you have a large bucket of money and you go to an insurance representative and you say, okay, listen, I want to have the best annuity that pays me the most amount of money, for my lifetime or for me and my spouse's lifetime. What they could do is they could say, okay, listen, we're going to throw you into an annuity. We're automatically going to annuitize this contract, meaning that you're going to receive a lifetime income amount every single year, either you or your spouse. But essentially, let's say if there was $100,000 that you gave to the company, and let's say you had it on your life only, the company might say, okay, listen, we're going to pay you $7,000 every year. Now you're racing against the clock. You're stating, okay, well, I have, almost 20 years to basically make back all this money. I have to live for another 20 years in order for this contract to actually make sense. If something happens, let's say, God forbid, you pass away in year one, well, now the company's walking away with $93,000. Your beneficiaries don't receive anything, and you don't have any control of that money. So that is the reason why I don't like annuitization with any sort of annuity contract. Each annuity contract, they offer annuitization, and a lot of times whenever you're looking at the terms of the contract, people get confused with annuitization and annuitizing your contract as opposed to actually leveraging specifically how that product was designed for. And this is leveraging the income rider aspect, because you do not have to utilize annuitization if you're using an income rider properly. So let's kind of I'm going to pull up a new screen, and I'm going to show you the difference between somebody that has an IRA, just a regular traditional IRA with mutual funds, versus a fixed income annuity. And for this example, I'm going to use the hybrid annuity. Fixed income annuity. Apologize for my sloppy handwriting. traditional IRA. And we're going to see, okay, accumulating this bucket for retirement, and then accumulating this bucket for retirement, and then what are the contractual guarantees on this side, what are the contractual guarantees on this side. Right now, let's say both of these individuals are age 60, and you're looking to take income at age 65, okay? If you had your money in a traditional IRA, you have it tied to mutual funds, okay? The amount of money that you place into that bucket, or the amount of money that's sitting in that bucket right now, and however good or bad the rate of return is, equals however large or small your bucket is at the end of the day. Now, with this traditional IRA, you could have this money somewhat accumulate, go up, go down, go up, go down, go up, go down, and then you have a bucket at age 65. Everything is a big question mark. If the market drops out like it did in 2008, you could potentially lose everything. You could, in 2008, you had the average portfolio lost 57%. But let's just say you're getting very consistent and now you have this bucket of money at age 65. How exactly do you know the correct amount to take from this bucket? And it's a very simple question, but it's a question that nobody really understands. They might try to lean on a wealth accumulation specialist that's going to tell them, oh, leave your money in the market and, you could take out about 4%. Well, if there's ways that you could have contractual guarantees and take out a lot more than 4%, wouldn't that be important to know that strategy? And so I guess part of the accumulation phase, already from age 60 to that 65 marker, when you're looking to retire, you have something known as reverse dollar cost averaging that could significantly impact this specific type of retirement account. What do I mean by that? If you have it tied to mutual funds, you have mutual fund related fees. If you're utilizing an investment advisor, wealth accumulation specialist, they're not going to be working for free. They're going to be charging you some sort of fee. Typically, that advisor fee is known as a wrap fee. This is about 1% on average. So let's say you have a mutual fund fee, average 1%, advisor fee of 1%. Now you have this downward market loss potential. In 2008, it lost 57%. Let's just say you lost 10% in a given year. You might have gained a couple, then you lost 10%. Right here, you have 3 constant negatives that could severely impact your account. You're not even touching this money. You're not even taking income from this money. And in this example, you've already lost 12% of your entire portfolio. Now, let's talk about at age 65. Let's try taking income from this account. Let's try taking that 4%. So if you had just say you had $100,000 sitting there for easy math, and you say, okay, at that point in time, I want to take out $4,000. You would have taken out $4,000 and you would have lost $16,000 based upon this sort of projection in that given year. You would have taken out $4,000, 4% of that $100,000, but you would have lost 16% of your portfolio. And if you multiply that out by a couple of years, all you need is a couple of market shifts and you have no money left. $0. I don't care what sort of advisor is going to tell you, oh, I have the greatest algorithms ever, and you're guaranteed to. First off, if it's an investment, you're never guaranteed anything. I want you to understand that very, very clearly. You don't want to deal with the Ponzi scheme. You don't want to deal with any of this stuff that somebody guarantees you that you're going to be getting these double-digit returns on your money. It's not happening. It does not happen. So essentially with this scenario, when you maximize this out a couple of years, understand the next year, if you want to take out 4%, you're not taking out 4% on $100,000. You're now taking out 4% on $86,000, but you're still susceptible to that mutual fund related fee, that advisor fee, and still susceptible to the downward market loss, and you're trying to take out income from that account. So this is the whole reason. This is what majority of individuals try to set up their retirement income planning as, and they fail. They fail miserably, and it costs them thousands and thousands of dollars in retirement, makes them stressed out as all heck, especially when they start hitting their 70s, their early 80s, because now they don't have any money in that bucket. Now they never had that peace of mind aspect of it, as opposed to utilizing a fixed income annuity. Now, with a fixed income annuity, we're going to utilize the hybrid example here. If you, at that point, at age 60, so we already know what could potentially happen on this side. if you just left your money doing exactly what it was, or you could preserve this. And let's say based upon your number, let's say you had $500,000, and and at any time, please give our 1-800 number a call. It's right up here, 1-800-566-1002. We're going to try to help you determine exactly what your specific number is, what your specific income number is, so that you could leverage the smallest amount of dollars possible. Let's say that your particular retirement goal, when you take into account with Social Security, possibly an employer-sponsored pension plan, when you take into the account with those two different income streams coming to you, and you also want to leverage your other retirement accounts, you might not have to utilize that full $500,000. Let's say that number comes out to $100,000. We're going to try to show you ways on how you could leverage an annuity contract with the smallest amount of dollars possible, so that you have the pure peace of mind and pure benefit that you know that exactly what your money is going to do for you. So let's just say you did a $100,000 rollover into an IRA annuity. What happens with this bucket is now it comes into, with this hybrid aspect, now this bucket has a little bit of a shell over it, and it's known as an indexing strategy. So every year, you have certain market indexes that you could choose, and there's only a couple because they would like to keep these products very simplistic. The more complicated, the more expensive it is with fees. So what they do is they say, okay, you might have an S&P 500 index. And what happens is, let's say you purchase this policy on January 30th of 2015. Now, January 30th of 2016, did the S&P 500 grow? If you had gains, you're going to participate in those gains. You could get double-digit gains in that given year. They're going to give you some sort of cap rate on that. Now, let's say that the market grew 20%, but your cap rate was 12%. That means at the end of that year, you would have 12% would get gained into your bucket, into your actual physical account value at the end of the year. Looks very good. The next year, let's say the S&P 500 lost 57%. Well, you gained 0%. It's a cap of a certain amount up to a specific stock market index, a specific cap, and you have a floor of 0%. So this allows you to have that safe consistency with your gains, making sure that you're eliminating that downward market loss negative on reverse dollar cost averaging. On top of it, there's no mutual fund related fees. This is not a mutual fund. You don't have any mutual fund related fees with that. Advisor, one of the things with my practice, the way I set it up, is we try to give you as much free content, as much free education as possible, making sure that you're acclimated to the process, and if you feel comfortable with everything, we're going to give you specific recommendations. We do not charge an advisor fee for our recommendations. We don't charge an advisor fee for any of our time whenever you're dealing with a representative. So already we're taking out the mutual fund related fees, the advisor fee, and we're eliminating downward market loss. So now we have consistency. Now we have, with upward market movements, we have that opportunity to beat out fixed type accounts, and meaning flat fixed rate accounts, such as a bank CD or a fixed annuity, but you have that potential to gain double-digit figures in a given year. So, and we're eliminating that downward market loss. So you're not having that reverse compound effect on your monies. Now, the most important aspect of this entire video is income. Like I mentioned before, I do not like to annuitize contracts. Now, let's say if your bucket was growing and growing and growing, and now you have a larger bucket, maybe you started with 100,000, now this bucket is 200,000 at age 65. If you were to annuitize this money, you would surrender all this 200,000, and then the company would pay you an income stream that you can never outlive. Remember, we're not doing annuitization. What we're trying to do is leverage something, and this is why I like the hybrid annuities, known as, and you have the kind of the secondary chassis, known as an income rider. So what this does is, as your bucket has been growing for those 5 years, for those 10 years, for those 15 years, for the 1 year, whatever it was, that your specific goal matched up with it, you have a secondary shell that shows you a contractual guaranteed income from an insurance company that states, okay, if you wait 1 year, we're going to give you lifetime income of X amount of thousands of dollars. Let's say you wait 2 years, then it's going to be higher. If you wait 3 years, then it's going to be higher. If you wait 4 years, then it's going to be higher. So this lifetime income rider is very, very important, but there's a large misconception there, because individuals think that, oh, whenever I hear something like a 7% guarantee, they think that they're actually getting 7% on their money. Whenever you're dealing with lifetime income accounts or lifetime income riders, what this is nothing more than a computation account. Whatever they want this number to be, whatever they're telling you, every year that you wait, you have to think of it conceptually just like Social Security. If you take on a Social Security at age 62, or you wait till age 64, you're going to have higher income at age 64 than you did at age 62. Or if you wait till age 68, you're going to have higher income at age 68 than you did at 64 and 62. So it's that same concept. It's not as if you gain something in this miraculous bucket of Social Security money. They're essentially just telling you what your lifetime income will be. Think of that lifetime income account the same for these hybrid annuities. So in one aspect, you have control of your money. Now, there's going to be restricted control within the first 10 years of these contracts and then full liquidity control after the 10 years. So as your money's growing, you could take out portions of that with free withdrawals, meaning if you ever have an oh my gosh moment, but you understand at that age 65, if that's your particular goal, you have a specific dollar amount that is contractually guaranteed by the insurance companies in your contract that shows you exactly what that lifetime income amount is. So it might be on you, it might be on you and your spouse, but what we're not doing is, let's say when you turn on that lifetime income, and let's say at age 65, this number is, 5%. We'll use very conservative numbers. They have companies have much higher numbers than that, but let's say it's 5%. You have a $200,000 bucket, and they said, okay, at age 65, your number is 5%. So we understand that year you're contractually guaranteed to get $10,000 every single year to the day that you pass away. Now understand something. If you turn on that lifetime income stream, you have $10,000. That's the floor of what you're going to be receiving. Every time that you take out $10,000, and let's say that you have no gain onto your actual account value, it's going to reduce your account value by $10,000. $10,000. Now, anytime that the market goes up, your account value is also going to be increasing. So you have, in one aspect, you have your peace of mind that you're going to be receiving that $10,000 lifetime income every single year. Because even if this bucket, let's say if you never have a gain ever again from the existence of the market, just never gains ever again, which is going to be completely unlikely, and you just keep pulling out $10,000, $10,000, well, you understand at the end of 20 years, you have nothing left in that bucket. If you have nothing left in that bucket with traditional IRA, you have no more money left. The reason why you leverage this fixed income annuity is, let's say if you had no money in your bucket, you still have that $10,000 is contractually obligated to go to you. And they still be paying you that $10,000 till the day that you pass away. Let's say if you live for 50 years. Well, then you were leveraging the insurance company the entire time, and they're still on the hook to pay you that amount of money that they gave you at inception of the contract. So it's very, very, very important to understand these. And I know that this is extremely sloppy right now, but I just want you to understand the concepts, that there's ways on how you could get this confident retirement. You could gain this peace of mind, and you could leverage this through current cash accounts, old 401k accounts, 403b accounts, TSP accounts, Roth IRA accounts, traditional IRA accounts. You could leverage that number, and you don't have to utilize the whole amount. Like some misconceptions out there is like, okay, I have $1 million in my 401k account, and okay, now I have to roll over $1 million into an actual IRA annuity. It does not work that way. Basically, we determine what your specific lifetime income amount is, your specific lifetime income that you desire, and then we match it up with the correct contract. There's over 300, 400 different contracts out there for that fixed income annuities, and the worst thing you could do is just try to throw darts at a dartboard. You want to be certain what is the best company for your specific situation, and that's something that we do very well. This is something that we specialize in, and why we've gained so much national recognition is because we have matched up the best possible strategies and the best possible companies. Because we're an independent agency, we're not going to be biased towards one company over the next. You could give us a call. Understand that you're going to be educated. We're going to educate you specifically on your situation, show you the different options that are available to you, and then make recommendations on what's going to be the best annuity or what's going to be that best product for first, second, third, fourth place based upon hundreds of different types of contracts. So we're going to make it very simplistic for you. If you like the recommendations at the end of the day, then obviously you could utilize one of our advisors. If you don't, then at least you were educated, because at the end of the day, you only have one shot to get things right in retirement. And that is the most important aspect. One of the things, we are Better Business Bureau accredited. We've never had complaints, is because the way that we conduct business. We want to build trust first and foremost. We want to give you as much free education as possible. And, we want you to be confident in a time that a lot of individuals are worrying about right now. So once again, 1-800-566-1002. My name is Derek Afasi. I want you to please subscribe to our YouTube channel so you get the most updated videos. And I thank you very much for watching this video.